Good Thursday afternoon, investors and traders, Phenom Group members, and our YouTube audience. Welcome to Phenom Group's weekly State of the Market. I am your host, Seth Golden. Wish I had better news for you, but I don't. For those of you who are here with us Thursday, you know what's going on in the market. It's quite ugly. We had a nice, robust rally during the Fed press conference yesterday with Jerome Powell. But all we've done since the opening bell here today was to give back everything that was gained yesterday and then some, with the NASDAQ down about 5%. S&P 500 at the moment looks like it's down 3.7, almost 4%. The downtrend persists. We've made lower lows on an intraday basis, on an intra-year basis, not necessarily on a closing basis this week. Monday, the S&P 500 dropped as low as, I want to say, 40.60 before rebounding. NASDAQ had an intraday low as well, right there, first trading day of May, and May's not going well as of today. NASDAQ dropped all the way down to 12,202 on Monday before having a really robust intraday reversal to finish sharply higher by more than 1%. Dropped 1% to start the day, more than 1%, and it rallied on Monday to finish up more than 1%. In fact, it did that yesterday on the FOMC day as well, twice this week. What does this tell you? Well, every rally is getting sold. The rally from yesterday has given up everything. And while this day may seem painful, the reality is we came into the week. This was Friday of last week. We closed at 12,334 on the NASDAQ. We're down about 50 points on the week in the NASDAQ. Down about 10 points on the S&P 500. So it's not as bad as it feels today, because today you just have a really accelerated and extreme drawdown in the markets. And, you know, is this normal for after a Fed day? Not really. In fact, the only other day after a big positive reaction to the FOMC day that we've fallen this much was 2011. This is the day after the FOMC day, where we rallied about 2% or greater through the Fed meeting from 2:30 to the closing bell. But then the next day in 2011, this is August of 2011, the S&P 500 fell about 4.5%. So yeah, that's the only other time we've had this kind of a day after the Fed move, when the day of the Fed meeting we had a strong gain. So very rare. And as we know, we're kind of going through some unprecedented times in the market. Everybody's going to make mistakes. Everybody's going to get caught off guard every now and then. Don't beat yourself up about it. I bought Alibaba when everybody was selling it. I knew about the headlines, the China tech crackdowns, and the inherent risk of owning a Chinese ADR. I read all the warning signs, bought, and I held on to Alibaba. This is going back to last year, knowing all of the risk. I did it anyway. I took a loss, albeit on a small position, but it was still on a, dollar-wise, it was a pretty nice loss. Why did I do this knowing the risk? The thrill of the contrarian potential? The inevitable end of the China tech crackdowns? You can ask any question. We all do it, right? We all take these risks that we know we shouldn't from, at one time or another. What I do know is that many of us will probably keep doing risky things with our capital, even when we try to stop ourselves. It reminds me of the infamous quote from Stanley Druckenmiller after he lost $3 billion during the dot-com bubble. And this is what he says. You asked me what I learned. I didn't learn anything. I already knew that I wasn't supposed to do that. So sometimes we know we're taking risk we shouldn't. We do it anyway. If you're doing that, trust me, everybody has at one time or another and repetitiously. But keep those risky bets really small so they don't hurt you too much. All right, why did I say that 2022 is kind of a unique year? This is the major indice. Well, this is the S&P 500 index ETF, the NASDAQ ETF, and the Russell 2000 ETF. And you can see they're all down on the year. Now, usually when you have equities down, bonds are higher. But that's not happening this year. They're selling bonds and they're selling equities, as you can see in the chart below of the bond ETFs. They're all down as well. So, if you can plan for all kinds of different things, it doesn't mean that the best laid plans are going to A, work, or B, keep you out of hot water. A 60-40 balanced portfolio got you nowhere in 2022. Exercising defense did little to help the drawdowns as both bonds and equities fell uniquely. Nothing is ever guaranteed when investing despite history. Exercising and eating clean won't keep you from never getting sick or worse. A sports team can immaculately prepare for an opponent and still get smoked. Following a recipe to the T doesn't prevent a sour apple pie. Your expensive wedding planner can't stop it from raining on the wedding day. Investing in 2022 is prime example of the best laid plans going haywire. Don't grasp at what you want or run from what you fear. The demons will always catch up to you. Just let it be. The right plan, process, and daily habits tend to reward their followers. Just be aware, they promise nothing. It's normal and natural for things to go wrong occasionally, as they're doing here in 2022. Perfect plans are a fantasy. The only fixed view you should possess is not having a fixed view in the first place. Wisdom is dynamic. The more we practice, the more it grows. So again, the price action has been treacherous here in 2022. We've had really good gains in the prior 3 years. Anticipate, expect, understand. This is going to be a difficult, challenging, stressful year for active portfolio managers. You're not in this alone. You're rowing the same boat as everybody else. How do I know? Let's look at the down volume today, given how big the drawdown is in all the major. The Dow was down almost 1,200 points today. So we're looking at the down volume on the NYSE because it's the broadest scale market. And as you can see, the down volume is 88% right now. 88% of the volume, the transactional volume today in the market is to the downside. It was above 90% at one point here during the day, and it wouldn't surprise me. It finished the day above 90%. You actually kind of want that because that's the capitulatory selling action that you tend to see that marks an interim, if not an ultimate low in the market. 90% down volume is what you're looking for. All right. On Monday, and we came into this week knowing we were in oversold territory. We're down 4 weeks in a row in the markets. We know we were in oversold territory. This chart right here is the PMO for all indexes. Okay, and what it identifies is, we were at the lows and we got bought. At the lows, got bought. Lows, got bought. We've been down here for some time now. So the bounce that we got on Monday, after we gapped down, we started to the downside. We made new intra-year, intraday lows on Monday, but too oversold and we bounced. Follow through on Tuesday, follow through some more on Wednesday. Here we are, taking everything back. That's the treacherous price action that I spoke of earlier. And it tells you we're in a downtrend, folks. Okay? We're in a downtrend. We're not making higher highs. We're making lower lows. That's the textbook definition of a downtrend. We just have to accept it, have the right expectations. Until we start making higher highs, we're stuck in this trading range. We broke the top of the volatility box. Now we broke the floor of the volatility box, which is a bit odd, but it speaks to the fact that there's little confidence in price. There's little confidence. This chart right here, and we broke through this today. I took this chart from a couple of days ago where we had fallen to support on Monday, bounced off this trend line, which goes all the way. This is the S&P 500. It goes all the way back to 2020, but it looks like we are likely to break below. And that comes in around 4150, 4160. We might finish below there today. And what that sets up is more downside, if not a test, right? On an intraday basis, we got down to 4060 on Monday. We may be heading back down there by the end of this week or next week if we hold below this trend line. All right, April stunk. Year to date stunk. What does that spell for May? It's not terribly positive. The average return when April is down, the average return is negative. And it's only the positivity rate is only 38%. So should we be anticipating a strong May? Not really. I mean, this is not, huge drawdowns after a weak May, but it's not a gain, period. This could be an outlier. There was a couple times, and back in 1990, very strong, 9% gain. We'll see. We're coming into the month of May. This is the worst start to a year for the S&P 500, going all the way back to 1930. Coming into this week, down 13.3% for the year, the worst start to a year since 1930. The second worst start was 1970. So again, have low expectations. If the market wants to rally, good, fine, great, let it rally. But we don't want to have the expectation that it's going to do so when most of the data says otherwise. All right. Worst performance through the first 82 trading days of the year as well. And these are the price returns from day 83, trading day 83 to year end. It's kind of mixed. 15 different times that the S&P 500 through day 82 was down 7% or greater. Got a lot of green here through the end of the year. Some red. One thing I noted when I kind of looked at each of these years, the years that the S&P 500 finished flat, right there, flat, it was 1970, we just spoke of, and 2020, So the years that the S&P 500 finished flat or higher, after starting the year this poorly, each time we either ended a recession or there was no recession at all. In 1970, it was the end of a recession. In 2020, it was the end of a recession. We had a gain. We were flat in 1970. We had a nice gain in 2020, or there was no recession at all. 1938, up 24.5% for the full year. After a bad start, we were down 7%. 1942, no recession, bad start to the year, down almost 12%. We finished the year up 12%. Are we going to have a recession this year? I mean, in order to stay at these levels, you almost think we have to, right? You almost think that we have to. Otherwise, we should have some nice rallies going on. Been asked about the 1982 analog because I haven't spoken about it recently. In April, we had big divergence. This in the red is 2022. In the black is 1982. I mean, we had a really nice mirror image going on here up until April, and then big divergence. We got alligator jaws, so to speak. Does this mean the 1982 analog is no longer in play? No. What if we do rally? Because in 1982, in mid-May, the market went down. And it didn't trough until August. So what if we have a strong May? we're going to converge, right? We're going to converge at some point if we have a strong May or June or July. We're going to converge again onto the 1982 analog path. So no, it's not off the grid. It's not out of play. With all analogs, it's not necessarily that you have to follow it, at the same time along the same price change. You can have a deviation. You're still in the same path, right? Because the ultimate destination is what will determine if the analog was right or not. So you're still on the same path, but you can deviate across a different plane of time within the analog. So we do want to still keep apprised of this, because there are a lot of different macro fundamentals that are extremely aligned. They were both midterm election years. Both had 3 rate hikes or more in the first quarter or first half of the year. Both times the CPI, Consumer Price Index, was 8% plus. Both are after recessions. Both had the January barometer and the toy barometer fail. They're both decennial years because they end in a 2. And the Bengals went to the Super Bowl in both years and failed. So a lot of similarities. I threw the Bengals in there for fun, as I did. Most of you have heard that before. All right. We've talked about the fact this is a midterm year, but this is the worst. It's the absolute worst performance through April of any midterm year, going all the way back to 1946. This is us here at the bottom. These are midterm years. This is the worst since 1946. That's how unique and unprecedented this year has already proven. Stocks don't always sell in May. You've heard the colloquialism, sell in May, go away. I mean, you go back to 2011, only down twice. 80% of the time been higher. The average return since 2011, 3.8%. So sell in May, go away. Not exactly. 2021, as you can see, I'm sorry, it's not filled in here, but we were positive in the month of May for 2021. 8 out of the last 9 years, the S&P 500 has delivered a positive gain in the month of May. When it does start to roll over, it usually does so around the middle of the month here. Starts out pretty good, but fizzles. Still with a positive gain above the 0 line here. This goes all the way back to 1950. This is just a snapshot of the trading days in the month of May. All right, a little bit about the NASDAQ, the worst months and forward returns. April 2022, the NASDAQ composite, not the NASDAQ 100, but the NASDAQ composite was down 13.3%, the 12th worst month of any calendar year since 1971. Why 1971? That was the origination of the NASDAQ Composite Index. Forward returns, there's more green than red, but there's too much red. And quite frankly, look at the years, 2000, 2001, not so bad until you got to the 1-year return mark. When you get out to 1 year and 3 year, there's a lot more green. But in this 1 and 3 month and 6 month time frame, quite a bit of red in there. November 2008, 2000s, 2008, 2000s, 1990, which was also a recession year. So 1980 was a recession year. 1987, we know what happened there, Black Monday, as they call it. So again, there's not a lot of optimism, from when you have a month this bad. It's 50-50 going forward. But we do have some other data that says a lot of the pain may be in the rearview mirror, and we might even get some robust rallies. The NASDAQ 100, right? So not the NASDAQ composite, but the NASDAQ 100. After a greater than 1% intraday loss, which was Monday, and it made a new 52-week low intraday, but then it reversed and finished the day higher by greater than 1%. These are all the times that has happened. Again, 1990, a recession year. 2001, a recession year. It happened several times, which tells you get these oversold bounces quite frequently. 2002 is the only time that this happened outside of a recession year, because if you scroll down, you got years 2008, we know, recession year, and it happened on Monday. So if anything, I mean, we know we're in a bear market for the NASDAQ, but only 1 year did this happen where we didn't also have a recession until now. So if anything, this might be a good recession indicator. Hopefully not, but it is, quite unique. Most of the occurrences were after the dot-com bubble burst or 2008. This is the first time outside of 2008 or the dot-com bubble that it's happened, but it happened on Wednesday also. It literally has happened 2 days in 1 week. That's never happened before. You can look at the dates. They're not within, this happened in not just 1 week, but 2 out of 3 trading days this happened. Again, that's never happened before. All right, so anyways, you can see there's still a lot of red on the screen. The day after that kind of intraday reversal, 50-50 chance of the NASDAQ 100 being up. 3 days later, which takes us to today, basically, Thursday, right? Because it happened on Monday. Here we are Thursday, 50-50 chance. And as of the last check, the NASDAQ 100 was red from Monday's closing price. 1 week later, which takes us to next Monday. So by next Monday, the positivity rate 1 week out, extremely low, only basically 30%. 2 weeks later, 1 month later, 2 months later, look how the positive, I mean, you're mostly red. The average return is down. Not great. Not great at all, right? Again, that's just 3 months. It's just 3 months. This is one study using these outside reversal days. And again, we had 2 this week. We had 2. Pretty remarkable. All right, so last week we talked about the corporate insider NASDAQ 100 buy-sell ratio, but I wanted to know if it was true buying or maybe the selling was light, so it inflated the buy side of the equation for NASDAQ insiders. Maybe that's why it was so elevated. But what I found was that's not the case at all. Here's the corporate insider sells, and they are, they're pretty low. There's not a lot of selling. It's a lot of buying. It's just a lot of buying. And when this has been in this range, 60% win rate, 65% win rate, meaning positive. And the average returns, not robust 1 week, 2 week, 1 month later, 2 months. But man, when you get out 6 months, the percent positivity rate or win rate, 91% and 99% 1 year later. So yeah, right now, man, the price action stinks. You're trying to trade, you're trying to scalp, and things are just going against you. We're making lower lows. It's a downtrend. But you gotta make sure you've got the cash on the sidelines to weather this storm. Because 6 months later and 1 year later, things are looking pretty good. Here's another study. I'll explain this one here, but the table shows you could still have a bigger drawdown, but 21 days later or 1 month later, positive returns here. Currently, this is as of today. This is today. We ran this, Jonathan Harrier ran this study. Currently, 98% of the NASDAQ 100 stocks are down on Thursday, 98%. This is the third day in the past 10 trading sessions with a reading greater than 96% of stocks trading down on the day. Third time this has happened in the last 10 trading sessions. It's only happened 14 other times since 1996. So in the past 26 years? Yeah, in the past 26, 27 years, it's only happened 14 times. It's happened 3 times here in the last 10 trading days. So now some will focus on the positive return, as Jonathan points out, but keep in mind that all but one of these cases, so it's happened 14 times, here's the dates, this is the low. So the drawdowns, I mean, there's some pretty 7% from the day of the signal, 5% almost here, 5% here, 18%. This is 2020. I mean, is this really going to be a COVID crash? So, but still, these are all 2020. So it kind of skews, the drawdown number. But, either way, it is important to point out only one didn't have a drawdown, and that was in 2018. That's the only one that didn't have a drawdown from the date the signal fired. Either way, a month later, of the 14 signals, of the 14 occurrences, only 3 occurrences was the market lower. A month later, only 3 of the 14. Looking out further, same study, same quantitative data, same 14 occurrences. If we go out 3 months, every single time the NASDAQ 100 was higher, and the average return was 15.6%, 3 months later. All right, so we're talking about 98% of stocks in the NASDAQ 100 are being sold today. They're down on the session. We talked about the down volume in the New York Stock Exchange. Let's see an update here, right? I mean, 88% down volume. 90% is like the breath thrust, the bearish breath thrust, which ultimately breeds some kind of capitulatory move to the downside, might mark a bottom. You take these 2 breath studies, if you will, put them together, you might have an even more durable bottom here for which we can get a more substantial rally with follow through. There's no guarantees, of course, but things are looking very, very capitulatory. The Dumb Money Confidence Index, this is by the Sentiment Trader, and the reading is extremely, excessively low. And usually when you get down here at these levels, the forward returns are pretty strong. 1% the following week, 2 weeks later, 1.4%, a month later, 4%, 2 months later, up 6%. The win rates or the positivity rate, very strong. All of them in the 80 percentile. 2 months out, you're in the 90 percentile. And that has the strongest return as well at 6%. So a lot of bearish sentiment in the market. You're getting these capitulatory moves. Correlations are moving higher, meaning that when everything's up, they're up. It's up together. When the market's going down, everything's going down together. We're getting a lot of correlation, and that's another sign of a local bottom. The bottom is close, if not an ultimate, at least an interim one where you can get a durable bounce that could last for a couple weeks, even a couple months. Unfortunately, a lot of the data that we've looked at throughout the course of this year has failed, right? I mean, at the end of April, with such a bad month already, right? The final 3 trading days we talked about, usually positive after such bad months. You're down 7% or greater already in the month with 3 trading days left. It's usually positive. Did that happen this time? No. We had to chalk this one up with more red ink. So I'm kind of hoping, with that in mind, that a lot of the data isn't working out. If we scroll back to this outside reversal study, maybe 1 week later, right? So next Monday, maybe will actually be positive. It's a low probability, but maybe this study won't work either. It is a nearer term study, right? 3 months, so we'll see. All right. We had the 50 basis point rate hike yesterday from the FOMC. Most people say, oh no, that's bearish. You know, they're hiking too fast. The last time that they hiked rates by 50 basis points was in 2000, right? But you know, they've done it throughout history. A lot of 50 basis point rate hikes throughout history. The average return 3 months later, 6 months later, 12 months later, you know, 81% positivity rates. 1 year later, only 55% positivity rate. Returns 1 and 3 months later. So sounds bad. Market tends to go up over time. Why? Earnings. If earnings are growing, the market will catch up to that earnings growth. So, all right. A couple weeks ago, we talked about the equity risk premium. What's going on in the market? Why do we just keep making lower lows? Well, bond yields keep making higher highs. So you still are getting this adjustment via the equity risk premium. We no longer have TINA, right? Everybody has heard the concept of TINA. There is no alternative, meaning there is no alternative to stocks because you can't get yield for your dollar, your capital and dollar investment anywhere else, right? I mean, real rates were negative, adjusted for inflation. So you go out onto the risk curve and you're buying equities because more than likely you're going to be able to get greater yield for that capital dollar investment. It's no longer the case. The 10-year yield has gone from 1.7% coming into the year. Today it touched 3.10%, 3.10%. I mean, it's just a huge rally in yields, right? Bond prices going down, equities going down, yields going up. So you have competition now. Equities didn't have competition for the last 10, 11, 12 years. There's more competition for that capital dollar investment now. The equity risk premium's going down, even though earnings are going higher, but yields are tracking higher and faster than earnings growth right now. So this is still just a market mechanical operation where equities are trying to find the right valuation based on a 10-year treasury yield at 3% or greater. Now, bonds are the most oversold they've been in decades. I wouldn't expect or anticipate bond yields just keep going higher. At some point, they are going to correct in the same way the equity market has corrected. All right. And this shows you know, the percent of S&P 500 stocks with dividend yields, right? Certain stocks have a dividend. S&P 500 stocks with dividend yields greater than the 10-year treasury yield. Only 21% of stocks right now have a dividend that is greater than what you can get from the 10-year treasury yield. And that's what we talk about when we speak of where can you find the greatest yield. It's no longer in the equity market. So now the equity market has to adjust to that and find an appropriate valuation where the risk is now more favorable than it was when the S&P 500 was at 45, 46, 47, 4,800. The market is trying to find that point. At the same time, treasury yields just keep going higher. It makes it very difficult to find a bottom in this environment until, and it will happen, it's just a matter of when, the bond market finds a buyer as well. S&P 500 bear markets chart. So if you're wondering, all the S&P 500 bear markets and how long they lasted, what was the average drawdown, what was the average drawdown in a recession or out of a recession, because not all bear markets coincide with a recession. A couple have happened outside of a recession. We've had recessions without bear markets as well. Still tracking capital expenditures. As I said before, market's doing one thing. It's adjusting to a new equity risk premium. But we're seeing business investment go up. We're seeing personal loan investments go higher. We're seeing earnings go higher. Heck, we've got retail sales. I mean, look at this. Does this sound like the consumer? Does this look like the consumer has a problem? For everybody that says the consumer's slowing, inflation is hitting their pockets, does this look like a problem to you? This is Johnson Redbook sales just this past week. This is like real time, high frequency data. It's not the whole last month. This is the whole last month. This is really strong, folks. Double digit year over year retail sales growth. Bank of America credit card data. Look at this. Total credit and debit card spending was up 13% year over year in April. The consumer slowing? That's the consumer slowing? These are the fundamentals. But right now, the market is performing an operation. And until the 10-year treasury yield finds its peak, if you will, or a point at which the valuation of the S&P 500 is just too darn cheap, investors are still going to be in sell mode. We have a buyer strike right now. It's just a buyer strike. It happens. Investors are a little bit uncertain. It's okay. This too shall pass, as they say. In between now and this passing, you've got to keep yourself apprised of the fundamentals. Technicals also. We've gone through a bunch of technicals here. But it all comes down to the consumer. Consumer's still healthy. Consumer's still spending. We're going to find that valuation point where it looks too attractive. Even if yields are still trending higher, the market will find that equilibrium point where the buyers finally come back in. With that being said, I'm Seth Golden. Thank you for joining me here on our weekly State of the Market.